Hello and welcome to this video in which we're going to talk about investments. But before we get started with investments, let's recap a few things that we already know. Our basic financial statements are starting with the income statement, in which we have revenues and expenses. These are events that have happened in the current period, and we recognize them in the current period regardless of whether they are realized or not, as in the cash flow impact. Gains and losses are realized in the current period, which means they actually happened, the transaction happened, resulting in the gains and losses. All of these are again relating to the current period. The end result is the net income number. That number is taken over into the statement of retained earnings. In the statement of retained earnings, we start with the retained earnings beginning balance. You add the net income number, which is the result of this first statement. Subtract any dividends that you have declared, and that gives you the retained earnings ending balance. We also know that we have the balance sheet in which we have assets, liabilities, and owner's equity. The current chapter we talk about an asset investments. Depending on how the management decides to classify the asset, it may be a current asset or a long-term asset. The fourth statement we know is the statement of cash flow. In the statement of cash flow, all our cash transactions are classified as operating, investing, or financing activities. Again, for our chapter, that's investments, depending on how it has been classified as a current asset or a long-term asset. The investment transactions will be classified as operating or investing, and we'll see that in the next few slides. Now, there's one more statement of comprehensive income, which we also will take into consideration in the current chapter. So what do we have in this statement? So there are certain financial transactions that bypass the income statement. If you recall, we talked about gains and losses, and there I said they were realized in the current period. Now we're going to look at gains and losses that were not realized in the current period. That's going to be a part of what we will discuss in the current chapter. There are various types of transactions that result in these unrealized gains and losses. In the current chapter, we'll be talking about something called available for sale securities. And in that context, we'll come back and look at other comprehensive income. So just want to throw that out there before we get started with the chapter. So with that, let's start with investments. Investments, basically, one company wants to borrow money or is looking for investors, and there's another company out there that is wanting to invest their money somewhere. So in this chapter, we're looking at the company that has the cash and is looking to invest it. So where could they invest it? They could buy stocks and bonds of another company. If they buy stocks, that's called equity securities. If they buy bonds or other notes, they're called debt security. Again, in this video, we're going to talk about investing in debt security. So who buys these stocks and bonds? It could be individual investors, mutual funds, or corporations. And in this chapter, we're looking at corporations. I'm a corporation. I'm looking to buy stocks and bonds of another company. So why would we do this? Why would anyone want to buy stocks and bonds of another company? Obviously, I want to earn some money. So if I invest in stocks, I'm going to get dividends, hopefully. If I invest in debt, I will always get interest. And the increase in market value, whatever price I buy it at, I hope to sell it at a higher price. So those are the two ways in which I can make a buck on my investment. Now, if I decide to invest in securities of another company, I may be able to control that other company. That's discussed extensively in advanced accounting, but for now, we'll take a cursory look at what investments in equity securities can do for us. Again, in this particular video, we're looking at only the debt securities. So anytime a company or any of us as individuals borrow money, there is a definite date on which a repayment happens. That's called maturity. When we say our debt matures, it means that money has to be repaid. Now, in this case, we are the ones loaning the money, so it will be repaid to us. The face amount to investors is paid back at maturity. So whatever is the face amount of that debt, that amount is going to come back. And during this period, while I'm holding the debt, I will be paid interest. So the company that's borrowing the money, it's an interest expense for them. For the company that has loaned the money, it's going to be interest revenue for them. Okay. Something else to note over here. Think about this. If you bought something like real estate, you bought a house. The house, whatever price you bought it at, the market value is not going to stay the same. It's going to go up or down. Usually for real estate, market value always goes up. Now, for debt security, a company has borrowed money and they have promised to pay interest at a fixed interest rate. The market interest rate is going to keep fluctuating. So the market value of a fixed rate investment, so the debt I'm buying has a fixed rate. The market value is going to move in the opposite direction of the interest rate that prevails in the market. So let's see what that means. I know what my interest rate is. I'm the company that has loaned the money, how much I'm going to get. If my interest rate is more than the market interest rate, then I can sell it at a premium. The word premium means a profit. If my interest rate that I'm earning on a debt is less than the market rate, then I'll have to sell it at a discount, which means it's basically at a loss. Again, this topic is revisited extensively when we talk about bonds, but now we're looking at this from the viewpoint of the investor. So again, I'm the investor. I'm investing in someone else's debt. How do I classify it? This classification is in my books. What is my intention? Based on my intention, I will classify it as held to maturity, trading security, or available for sale. Remember that available for sale, we mentioned it earlier. We'll talk about that now and see how it affects the journal entries we do based on this classification. So let's start out with held to maturity. So I'm the investor, I'm the corporation who bought another company's debt. I have the intention and the ability to hold the securities to maturity. So when another company issues bonds, when they sell bonds, they're borrowing money. Bonds are long-term. On the short end, it'll be 10 years. Long-term bonds could run as much as 50 years. I'm loaning someone money and I'm saying, let's say it's a 10-year bond. I'm loaning you money and I'm saying, I can wait. I have the ability to wait and I intend to wait. Both conditions have to be satisfied. Then I can classify it as held to maturity. So maturity date again is the date the securities mature and I will get my principal money back. This principal is also called face amount. And this money at maturity is repaid to the investor. I'm the investor, I'll get the money back. And on interest dates, the predetermined interest date, interest is paid to the investor, which means I receive interest, it's interest revenue for me. Now, how would this affect my financial statements if I classify it as held to maturity? Again, I have the intention and the ability to hold these bonds until maturity. So in the income statement, when will I realize a gain or loss? Only when I sell it. Okay, so only in the period in which I sell, I'll recognize any gains or losses. Well, what about those unrealized gains or losses at December 31st? Let's say, for instance, I paid $50 million for these bonds and the market value is $53 million. I have an unrealized holding gain. That's going to go into the notes to the financial statement. It doesn't trigger a journal entry. I'm not going to do anything about it. I'll just put it in the notes to the financial statement. Okay. In the balance sheet, it is classified as a long-term investment and it is reported at amortized cost. We'll see how to do that. And if there is any concern that the value of these bonds have gone down, this unrealized holding gain or loss, if it's a loss and we think it's more permanent, we may want to consider creating an allowance account. So this is at the discretion and depending on circumstances, at the discretion of management. This allowance account, it's very, very similar to what we do with accounts receivable, creating the allowance for uncollectible accounts. So here we are saying there's a chance I may not get the full amount at maturity. Fair value of these investments, again, that generates this unrealized holding gain or loss. We're not going to do any journal entry. Fair value is reported in the notes to the financial statement. So in the notes to the financial statement, I'll say at December 31st, this is the fair value. This is the unrealized holding gain or loss. Pretty much no one reads the notes to the financial statement, and that's where that information goes. So once again, when I buy the asset, I will have a journal entry. When I sell it, I will have a journal entry, and I will realize the gains or losses at that point of time. Realize and recognize those gains and losses. In the statement of cash flow, it's classified as investing activity. If you recall, I told you, if the asset is classified as the long term, it's a investing activity. If it's classified as short term, it's current asset, and then it'll go into operating activity. Once again, held to maturity, I have the intention and the ability to hold it to maturity and collect interest as time goes by. So gains and losses, only when they are realized, that is when they sell. In that period, I will recognize them, not until then. Unrealized holding gains and losses, no recognition. Fair value, no recognition, it just goes into notes to financial statement. In the balance sheet, I'm going to hold it at amortized cost. And in the statement of cash flow, buying and selling are classified as investing activities. I mentioned this a little a couple seconds ago over here, that generally I'm going to hold it at the amortized cost. But if these unrealized holding gains and losses we think are a little more of concern, then we use the current expected credit loss model. And basically this says I need to create an allowance account. So again, this is very similar to creating the allowance for uncollectible accounts for accounts receivable. This is if you think there's a permanent impairment, likely to be a permanent impairment in this investment. Okay, let's move on and look at the second type of classification, and this is trading security. So held to maturity, I'm saying I want to keep it all the way until the end of the life of the bonds. Now this is at the other extreme. Here I buy them with the intention that in the very near term, I'm going to sell them. Okay, I don't intend to keep them long. So these are actively traded securities. Holding period could be in hours, not even in days or months. Okay, so they very clearly are trading securities. Held to maturity, I'm saying I'm going to keep it all the way until the end. Here I'm saying I put my money in, I'm going to take it out real quickly. So it's going to be classified as a current asset. Fair value is more relevant over here. So what do? The balance sheet, I want to carry the asset at fair value. December 31st, if the value of the investment has gone up or the value of the investment has gone down, I want to recognize it because I intend to sell it in the very, very near future. Okay. Unrealized holding gains and losses are included in the income statement. They are unrealized, but I will still include them in the income statement simply because I'm saying that it's more likely than not it's going to happen very soon. Okay. So for the financial statement presentation, trading securities, gains and losses are included in the income statement when the fair value changes, regardless of whether they are realized or unrealized. For held to maturity, we said only if it is realized, we'll recognize it in the income statement. If it's unrealized, we do nothing about it. Here we are saying whether it's realized or unrealized. Realized means I actually sold it. Unrealized means I've not sold it on December 31st, but I'll still put it in the income statement. Balance sheet, it's a current asset, and I'll report it at fair value. Statement of cash flow, it's going to be an operating activity because I classified it as a current asset. When I buy or sell this, it's going to be an operating activity. Now let's go to this third option I have, available for sale. So here we are basically saying they're not held for trading, nor are they designated to be held to maturity. So it's basically, I know I'm not going to hold it to maturity, but I don't know if I'm going to sell it right now. Okay, so it's an in-between classification. I'm basically saying over here, I'm going to hang on to this, but if the price is right, I'm going to sell it. Okay, so it is reported in the balance sheet at fair value. So in the balance sheet, we're saying we're going to pretend this is trading security. I want to put this as fair value. However, I may hold on to it. So this unrealized holding gain or loss, I don't want to put it in the income statement. I'll put it in the other comprehensive income. I'll put it as other comprehensive income in that statement of comprehensive income. So I kind of want best of both worlds over here. Again, held to maturity, I have the intention and the ability to hold it all the way to maturity, however long that is. Trading, I intend to get rid of it very, very quickly. This one I'm saying, I'm not going to sell it right now. However, if the price is right, I'm open to selling it right now. So in the balance sheet, we act as if it's trading security. In the income statement, we don't want to show the unrealized holding gain or loss because it's really not trading security. So we just bypass the income statement and call it other comprehensive income. So gains and losses are shown in other comprehensive income in the period in which a fair value change occurs. So at the end of the year, if there's a change in the fair value, I put another comprehensive income. Those amounts are reclassified out of other comprehensive income and recognized in net income in the period in which it's sold. So I carry this unrealized holding gain or loss and other comprehensive income. I'm parking it over there. But the minute I decide I'm going to sell it, I reclassify it as trading and then I sell it. Okay, so a reclassification is going to happen over here. In the balance sheet, I'm reporting at fair value. Unrealized holding gains and losses, I'm no longer ignoring it, but I'm putting it under the other comprehensive income. And it becomes a part of its accumulative number. It becomes a part of the accumulated other comprehensive income. So in the statement of cash flow, where should we put this? Is it a current asset or is it a long-term asset? Okay. We are going to treat it as a long-term asset and classify it as investing activity. So we're kind of saying this is in between. If it was available for sales, if it was trading security, it's a current asset in the balance sheet, and in the operating cash flows, it's going to go under operating activities. In the income statement, unrealized holding gains or losses are affecting the income statement. If it was held to maturity, in the balance sheet, I would call it a long-term asset. Therefore, in the statement of cash flow, it's going to affect the investing activity. And fair value at the end of the year, I pretty much ignore it. Now, available for sale is in between. In the balance sheet, I'm classifying it as a long-term investment. Therefore, in the statement of cash flow, it's going to be an investing activity. However, any unrealized holding gains or losses, I'm not going to put it in the income statement, nor am I going to ignore it. I'm going to put it as other comprehensive income. So this is the in-between place where we put it. Well, what happens if the available for sale security is impaired, which means the value goes down? So this is a little complex, and when we go through an exercise, you will see how it is to be done. So I'm just going to kind of skip through this at this point of time and just try and summarize once again the three classes of investments. So I've invested in the debt of another company, bonds of another company. Bonds are long-term. I don't have to keep my money there long-term. As long as there's a market for it, I could sell it at any point of time. But what is my intention? If I have a positive intention and ability to hold to maturity, I'll call it held to maturity. Unrealized holding gains or losses are not recognized. In the balance sheet, it's at amortized cost. If I intend to actively trade it, which means sell it, I call it trading security. It's a current asset. In the income statement, I will recognize any unrealized holding gains or losses, which means in the balance sheet, I'm recognizing it at fair value. At December 31st, if I see it's up or down, it affects my income statement. If it's available for sale, in the balance sheet, it's at fair value, but it won't be in the income statement. It's going to go into the statement of comprehensive income. I'll put it over there with the other comprehensive income items. So with this, I'll stop this video. And in the next video, we'll go over exercises, seeing buying these stocks, not stocks, buying these bonds, selling these bonds, collecting interest, and doing year-end adjustments. So see you in class.